Hey, this is a short explainer video for the dynamic spread strategy for Raindex. So this strategy is designed for market making. So market making is generally the idea of offering both buys and sells at the same time for other market takers to come and either buy or sell in the moment. So the market maker is trying to provide liquidity for trading all the time. They're not just looking to do a single trade and leave. They're trying to be playing both directions of the market all the time. And ideally, they can make some profit out of this because that will help them be sustainable in the market making over a long period of time. But sometimes, or often, the main goal of the market maker is to make the market, as in make sure that there is a market available for people to be trading against all the time, because offering trades in both directions means that other people can always buy or sell when they need to, in hopefully the amounts that they need to. So that over time gives confidence in the market and generally provides a smoother experience for everybody who wants to be in that market, and generally benefits the market growth over time as well, both volume and hopefully price discovery as well. So the market maker in this range strategy has two things to generally consider. The market could be trading in a range, or it could be trending in a particular direction. So if the market is trading in a particular direction, the strategy has to try its best not to overcommit to one side of the trading. For example, if the market was going up and the strategy was continuously selling because it saw that the market was going up, eventually it will run out of tokens to sell, because it only has a finite amount of tokens in its vaults. And the same thing, if the market was going down and it was buying some tokens, then eventually it'll run out of dollars or whatever it's using to buy those tokens on the other side. So it needs to try to respond to the market in a way where if the market moves, it can quickly readjust itself and then settle into the other mode of the market, which is when it's ranging. So it might be going up and down, but it's typically staying within some price range, and so the buys and the sells can broadly alternate to some degree. So when some tokens are being bought, they can be sold again and then bought and sold again, so there's actual balance in the market at that point. So when the market's balanced, the market maker is sitting there between external traders who want to buy and sell, and it's not directly matchmaking them, but it's sitting there at the liquidity level, at the trading level, providing the buys and the sells, so that if one person is buying today, then the market maker can facilitate that, and then somebody else could sell tomorrow and the market maker can facilitate that, and sort of indirectly the trades are cancelling each other out. So it provides the ability for people to trade without actually the need for matchmaking directly between those people. They don't even need to know who they are, and they don't even need to be trading at the same time. So that's what the market maker wants to be doing while there's balance in the market, but they don't want to be on the losing side when the market trends. So we can see that in crypto broadly, the way that people do market making is often by putting tokens into a liquidity pool on Uniswap, for example, and that has a particular algorithm for how it does the market making. And this strategy on Raindex is an alternative. So it's also an algorithm, but it is based on time rather than being purely based on balances, which is what Uniswap does. So the way that it works is that initially we would have, say, some price that the market is at externally. It doesn't really matter what this price is, because the strategy works the same regardless of what the price is. And then it would set two initial points above and below like this. So let's say it was 1% was the spread. Then it would add a percent up here for where it's going to try to sell. And then it would add a percent down here for where it's going to try to buy. And initially that's not going to trade because this is where the price is. So nobody wants to take this price and nobody wants to take this price. But what's going to happen is the strategy is going to exponentially do this. Okay, so when I say exponentially, I mean this is actually a half-life curve, which means that every time we go an extra unit in this direction, say an hour, so say every hour, we're going to halve the spread here. I didn't draw this exactly right, but broadly it's kind of right. Basically, you can see that after one, say this is an hour, after an hour, we've gone down half. And then after another hour, we've gone down another half. And then after another hour, we've gone down another half. So this is roughly a half-life here, this curve here. And it's the same on this side. So it's perfectly mirrored originally around this point. So what this means is that if any movement in the market happens at all from the initial point, eventually these curves are going to get so tight around this midpoint that it will cause a trade to happen, right? So if this market is going up and down, but then eventually goes down here and intersects with the curve here, a trade's going to happen on the way down. So when that happens, the strategy is going to record the trade, and then it is going to put two new points, 1% and 1% above and below this new point. So the same relative percentage gap that we started at is now going to apply to the new point at which we crossed this curve for the spread. And then we're going to have new curves like this again. So let's say the market continues on its way down, going into a dip, it's going to intersect again at the curve at some point in time. But now, from the second trade onwards, instead of just moving these percentage 1%, 1% spread above this new point, we actually move the bottom percentage 1% below the latest trade. So it's going to come down here. And then we calculate the average of all of the previous trades according to their size. And we're going to put this sell side 1% above that. So let's say the average was here. I'm just going to put it halfway between these two for simplicity for now. Then the sell is actually going to start 1% above that. So a little bit below here, but not as far down here, so like this. And then you're going to see both of these curves on the new price points are still going to go towards this average. Okay, so I might use a different color just to make it a bit clearer. So from here, we're going to go like this. Okay, this is going to curve towards the average, and this one is also going to curve towards that. Oops. It's also going to curve towards that same average. Okay, so this curve is actually going to be a little bit faster than this curve because we've started at 1% away from the last trade rather than this average. And generally when you're trending like this, the last trade is going to be moving faster downwards than the average is going to be moving, because the more trades that you are averaging something over, the slower it's going to move. So if you're familiar with trading graphs, you would have seen this when, for example, a 200-day moving average is moving much slower than a 5-day moving average because you're averaging over a lot more data, so it's going to move a lot slower. And when you're just taking a single data point, which is the last trade, then it's basically instantaneous. There's no averaging happening at all, so it's going to move exactly to wherever that market is at. It's going to jump 1%. And also when you parameterize these things, when you're launching the strat yourself, this is all configurable. So it doesn't have to be 1%. You could set it to 5% or 3% or 0.5%, whatever you want is the spread that the strategy will do when it's readjusting. And it's going to continue to do this over 3 trades, 4 trades, 5 trades, however many trades there are. It's going to recalculate the average. And also, I didn't mention this earlier, but because the strategy wants to move with the market, because it doesn't want to sell out on one side when the market is moving, as I said at the start, it will actually make the trades larger in size earlier in this curve. So when the spread is further away from the average, this line in the middle at this point, the trade sizes will be larger. And then when it calculates the average, it weights the average according to the trade sizes. So if the market here, actually we can leave the same color, if this market went down very quickly here, a big crash right here, and intersected very quickly down here, then this would be a large trade. So when we readjust this average according to this trade, it's going to move closer to this more than it moved closer to this one, because this one's quite far along the curve. Okay, so the actual size of all of the trades is considered in calculating what the average is across all of them. So larger market movements will move the average more towards that new price. So if the market is very flat and is not doing anything for a long time, we see two things. We see it take longer for the trades to happen because we have to get the spread to be tighter before the trade will actually happen because the market is trading in a small range. And we also see the trade sizes are going to be smaller because the trade size is a function of where you are along this curve. So it's smaller as it goes along. So by having less frequent trades and smaller trades, the strategy tries to protect itself against overcommitting to a small range and being able to adjust when the market moves, even though it's still in the process of always providing trades in both directions. So that is how it attempts to balance the two constraints, that the market is going to stay in a range some of the time and it's going to be moving in one particular direction some of the time. So while it is moving, it's making bigger trades and faster trades. And then at some point, the market is going to go back in the other direction. All right, so let's say we've done this, we're 3 trades in, and let's say the new average is, well, this was a big trade. So let's say the average has moved quite a bit, and now it's down here, okay? It's not very straight. So we can use a different color. Let's say green, because we're going to go back in the other direction. So now the last trade was down here, so we go percent below that for this curve down here, and then the average is here, a bit above it, so let's go percent above that for this cell, and then we're going to do this, same thing. This curve's going to be quite steep now. So this is where the market is now, and this is the new curves. So let's say it goes back up and intersects here. Now this is above the average price and it's a sell, so we're going in the other direction, and this time instead of the sell causing the average to move, what we actually do is subtract the size of this trade from all of the trading activity on the buys. So if the total of these three trades was, say, $300 worth of trading, and then we do a sell for $100 over here, then we're going to subtract that and we're going to say, okay, well, this average now is only going to represent $200 worth of trades. So we're basically offsetting the sale against the previous buys that we did. And because we know that we're selling above the average of all those buys, we know it's profitable, right? So if we bought at some average price across all of our trades, and then we sell above that average price, we know that we're making a profit. So this sell is profitable on average, even though this sell might be below this first buy, because it's enough above this buy and this buy and this buy, on average, it still works out to be a profit overall. So the better buys work to offset the worst buys. This is in hindsight, this was a bad buy because we actually ended up buying above the current sale slightly. But this buy was a much better buy, so on average we're still up. And this will keep happening as long as sells are happening until we have exhausted all of the tokens that we allocated to this average, which is no longer moving as long as we're doing sales. And then if we continue to make sales, the exact same process is going to happen in reverse. So we're going to start tracking the average sale and have a moving average in the sale direction until things move back and we start doing buys again. And then we're going to start associating those buys against those sells. So this strategy works exactly the same way in both directions. Whichever direction it starts moving in, it'll start a tally of how many tokens or dollars or whatever it is accumulating in that direction. And then as soon as the direction changes, it's going to start undoing that tally until everything is cancelled out. And in the full process of racking up a tally and then deleting it again in the other direction, it'll end up with a profit relative to where it started, because in this example, all of the sells are happening above the average buy price. And it would be the same in reverse. All of the buys would be happening below the average sell price. So we know that it's always profitable as long as we follow this process. And we also know that when these sales are happening and they are making the average over a smaller number, if this reverses again and we start going back in the other direction, we do another buy, this average becomes more sensitive. So even if we don't fully sell out of all of the buys that we did here, the sales, by shrinking the number of, well, by shrinking the volume that this average is over, the next time we have a buy, this will be more, this will move more. It'll move closer to the actual real value of the market faster. So even if we don't fully sell out and then start a new tally in the sell direction, the sells are still beneficial for us, not just because they're profitable, but because they allow us to partially reset some of these average calculations so that future averages can be more accurate and more in tune with the market. So effectively, that'll mean that the distance between the last trade and the average price is going to be smaller on average if we can intersperse a few sales. So even if the market is going down, as long as we can get a few sales in along the way, we will be able to keep the spread relatively tight. Okay, if we made no sales and it was just down, 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 and we're just buying, 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 what you would see is the last trade getting further and further and further away from the average, which will have the effect of making the spread larger because the buys are relative to the last trade and the sells are relative to the average. So if there's a bigger distance between the last trade and the average price, then there's a bigger trade between our curves. So the spread will be bigger. So we, as the market maker who wants to be simultaneously offering a good spread, because that is good for the health of the token, and also means that we can make more buys and sells, which also means we can theoretically make more profit while the price is in a range. We also need to be protecting ourselves against the market moving. So partially deleting the history of the trades whenever we cross over in the other direction helps us stay sensitive to the market. And there's also a parameter in the strat itself, which is the maximum trade history that you keep. And you can set this to a very large number, basically infinity, and it will cause the strategy to work exactly as I've described it here. But if you set it to some relatively small number, then it will put a cap on how much volume it can track. So if you had a history cap of $100, and let's say again that this was $300 worth of trades on the way down, the strategy won't actually keep $300 worth of trading history. It'll only keep $100 worth of trading history. So in this scenario, that would actually be quite a sensitive trading history compared to this market. So that is a trade-off that the person who is deploying the strategy is making, where they say, I don't want to keep full trading history, which will make my averages more sensitive, which means that my spreads will be smaller, because having a more sensitive average means that the gap between the last trade and the average will be smaller, because basically we're saying let's ignore some of these older trades. Okay, we're going to start ignoring these older trades because the market's moved, these older trades are less relevant. Okay, so now we're down here, but then because those spreads are tighter and the average, because we've moved the average faster, then the trade-off is that these sells aren't necessarily going to be profitable anymore. So if the average is moving further than it would have if we had kept all of the trading history, and then you delete some of that trading history, then you're opening yourself up to the potential of some of these sells on average being, the sells being less than the average of the buys. So then you can lose money. But that's the trade-off. And in theory, that could be okay. You still might have a profitable strategy, because if offering a tighter spread means that you can make more trades, then the fact that you are making more buys and sells in the new range because you've adjusted to the market more quickly, and you're now more accurately rotating your tokens in and out between buys and sells at the new market price, the profit that you're making from those extra trades might partially or offset the loss that you made from moving the average too quickly relative to your earlier trades, but there's no mathematical guarantee of that. So this is a decision that has to be made by the person who puts the strategy up, whether they want to prioritize absolutely guaranteeing that whenever the tokens rotate, it allows for a profit, even over a very long period of time, or if they want to allow for older trades to basically expire from the trading history. And so when they expire, it allows the spreads to be tighter and then more trading will happen, but there's no guarantee that they'll happen at a profit or a loss. So it becomes a bit more luck-based rather than mathematical, but it also should result in tighter spreads and more liquidity, basically, at better prices being offered by the market maker, which, if the primary goal of the market maker is to offer tight spreads, they might want to set the trading history quite small or potentially even zero. It is possible to set the trading history at zero, and if you do that, then there's effectively no average cost tracking. What will happen is that the curves will start 1% above and below, or whatever percentage you set, of the last price, always. There'll be no average causing this asymmetry between the buys and the sells. It'll always just be percentage above and below whatever the last trade was. So that's certainly a much simpler strategy, which will cause tighter spreads, but whether the strategy is sustainable and making a profit over time is going to be really down to market conditions as to whether or not there's enough trading happening during those periods of relative price stability versus what happens when the price eventually moves somewhere else and then everything needs to readjust, but you haven't actually tracked the history, so the strategy has no way of helping itself actually offset those price movements. But that's all configurable. It's entirely up to whoever deploys the strategy, whether they want to make that trade-off and how much of that trade-off they want to make. It's not an on or off switch. You set exactly how much trade history you want to be tracking as a max. It's a cap. So as soon as it hits that cap, it's just like basically some of the information from the older trades starts getting replaced with information from the newer trades in that average. So yeah, that's basically the dynamic spread trading strategy.